So today I want to talk about some of the use cases and give you a little bit update, and then we'll have a Q&A session. So a quick recap of what we talked about in the previous session, which was our first one. We had a brief of what a blockchain technology is, right? And we understood, we talked about that this is a time-stamped append-only lock in which each of these blocks are chained together using hash and cryptography. So I'm not going to get into the details of those. And this whole blockchain is secured by a network of computers. And there's a whole game theory involved in it, which ensures that those computers, also called as nodes, also called as miners, they do the right thing. They stay honest. That's what the whole magic behind blockchain was. A little bit of a hash functions and cryptography using public and private key. We also looked at how the blocks are chained together. And this is what makes it, this whole blockchain very secure, is each of these blocks have an information about a previous block. So if I start a new blockchain today, I have this block 0. We do another transaction, create next block, it will have an information from this block 0. And that information is a hash of this. Create a block 2, it has got a hash of block 1, which in turn has a hash of block 0. So now, as more and more blocks are created, each one of the succeeding blocks have an information about the previous block, which has information about one previous one, has information on one previous one. So if anyone wants to go and tamper with something that has already happened in the past, not that malicious player not only has to tamper a block, but has to also go and modify all the subsequent blocks. And this is to be done not only on one computer, but on majority of the nodes that exist in any blockchain. That's why it becomes virtually tamper-proof. You need to have an extremely high computing power to go back and change the data in any blockchain. That's what makes in this context, the oldest blockchain we know of is Bitcoin's. That's what made Bitcoin so secure that it has never been hacked. The blockchain has never been hacked. And I'm sure there are multiple attempts happening every day to hack that blockchain. If someone can go back and reverse a transaction or feed in a transaction which says against my name or my ID, I got a few hundred Bitcoins, oh, that would be great. Or a few thousand Bitcoins. But you just can't do that. It is virtually tamper-proof. So a quick summary was that blockchain, it's an open ledger. The public blockchains, you and I, each one of us can go and see who has what. When I say who has, I'm not specifically talking about the names. We're talking about what address, or in our normal parlance, what account number has what balance. I may not know anything about that account number holder though. So it's a public ledger. It is shared among thousands of computers. This blockchain is nothing but a ledger of transactions. Anyone can inspect the transaction. Oh, we looked at what's a Satoshi Nakamoto's ledger has, how many Bitcoins he has in this particular address. Because it is open, it is public. So we finished our previous session over here. We got a lot more details, and this is a quick recap and summary. If you have any questions, feel free to ask in between. You can speak if you're okay with that, or you can type in your questions. I will try to monitor the chat as we go along. So that was the basics of what a blockchain is. Next, great, we got a blockchain, which is an immutable ledger. which is available for everyone to inspect, which is virtually tamper-proof. It was first created by a person, a group of person, a company, an entity, he, she, they, we don't know. A pseudonym called Satoshi Nakamoto. And during that, Satoshi just used it to put an entry around who owns what. He started with it when he had an initial mine the initial Bitcoin, and then as and when people start to mine the Bitcoins, the entries were added into that ledger. That's what the blockchain ledger, the Bitcoin ledger is. That's all you can find out from a Bitcoin ledger is what address, where the Bitcoin, whether what number of Bitcoin has come into it, what number of Bitcoins has gone out of that ledger. It's an open accounting ledger. So let's look at the use cases of some of these blockchains and how can these be used. First use case is any store or asset of value, right? Which is, could be money, could be gold. I mean, gold is an asset of value. We mine the gold, and then if I buy it somewhere in the ledger or in my house, I have a record of, okay, I bought the gold. So the Bitcoin blockchain, when it was created, its sole purpose was to record who has what Bitcoins and create an ability to mine the Bitcoin. We talked about the mining process in our first session in terms of you have to, when you have to mine it, you have to work. And that is what is called proof of work. And when you do the work, you get awarded a Bitcoin. Then if I want to, it's like gold miners. They mine the gold. And if I want to later on go and buy the gold from miners, I can buy it in an open market because I think gold is a store of value. It will go higher later. So I might want to hold the gold. Similar concept, Bitcoin becomes store of value. Either I can mine the Bitcoin or I can go and buy it from an open market, which is the exchanges that we have, Coinbase, Kraken, Binance US, and these few are the US regulated exchanges. And then there are many other exchanges outside of US. So the first blockchain that was created was for the purpose of recording who has what Bitcoins. And as and when Bitcoins were passed along, if I give a Bitcoin to that pizza to Papa John's, who received 10,000 Bitcoins for 2 pizzas way back in 2013, or I can't remember, 2011 maybe, because no one wanted any Bitcoins. So who was the name of the developer? I forgot. He offered 10,000 Bitcoins for 2 pizzas. That was recorded in the Bitcoin blockchain. It's a ledger and accounting system secured by the most powerful network in the world. And because it is secured, it is virtually tamper-proof. It has never been hacked. You need a humongous amount of computing power, which means you need to spend so much money to hack it that the whole purpose of hacking is defeated, because you already are spending so much money to hack it that what you may gain actually is not really worth to hack it. So that's why on a Bitcoin, there's a high degree of confidence. So why could this be turned as an value, an asset with a value in it? Today, why the institutional investors are buying Bitcoin? Why they think it could be a store of value in this. It could also be used as a currency. But today, I don't think anyone would want to use it as a currency. They all want to use that as store of value. When it was created, its purpose was maybe we can use it as a currency. Also, currency has a value. So why it has got a value like money? So let's look at what are the various characteristics of money. Money must be durable. Today, if I own a dollar, its value, it should still be strong enough that I can use it over and over again. Portability. Money must be portable. If I can't carry my dollar bills from one shop to another, then the usage, it won't grow as a usage. Gold is durable. Gold portable, maybe. If you're having a gold coin, yeah, you can carry it, but you may not be able to, not every shopkeeper will be accepting gold as a payment. But I would still say gold is portable. Some of the money or the store of value objects few centuries ago were like as heavy as 200 pounds. Those were rice stones. Those are not at all portable. Money should be divisible. I should be able to divide money into a smaller component so that if something is cheaper, I can pay into those smaller units. Money should be uniform. Doesn't matter which mint has printed the bill or the coin. 1 cent is 1 cent. Whether it is printed in a mint in Philadelphia or somewhere else. It's a uniform. It should be a little scarce. Though now I have a question based on what our Fed is doing. But if it is available in ample amount, then there is no value. I mean, silica is available sand is available in ample amount. We don't value it much. So anything of a value means there has to be little scarcity built in. So it's the case with money. I cannot create money out of thin air. Only Federal Reserve decides how much money is to be put in circulation for people to use. It's a little scarce. And lastly, it should also be acceptable. What good it is if we as a society are not in a consensus that, yeah, I'll give you the goods if you give me this money. So it must have that acceptability, either as a currency or as a store of value. Anyone, the other person should be willing to hold it in exchange for goods or services. So now let's look at how is Bitcoin similar to these or concept of money. It's durable. Once you create a Bitcoin, it'll stay forever in the digital world. Sometimes the dollar bills get destroyed in the washing machine. I forgot to take it out of my jeans pocket. My wife didn't check it. My mistake. I should have taken it out before putting my jeans for laundry, and the dollar has gone. Bitcoin created will stay forever. It's portable. I can carry Bitcoin in my cell phone. Easy. Or laptops. It's divisible. 1 Bitcoin can be divided into 1/1,000,000th of a Bitcoin. That's the smallest unit. So a great thing about it is if as an investor or a trader, if we want to go and buy a Bitcoin, we don't have to buy one. I think it is $40,000. Don't have that much money. But we could still go ahead and buy 0.0001. We can buy up to 1/1,000,000th. So it is divisible. It is uniform. Whether it is mined by a miner in China or US or wherever in the world, a Bitcoin is a Bitcoin is a Bitcoin. It is scarce. 21 million is the maximum number. Currently, 18.5 million are already mined in circulation. Remaining are expected to be mined by 2140. I won't be around for that moment when all the Bitcoins have already been mined. So, and it has got a predictable schedule. We know that every 10 minutes, 6.25 Bitcoins new Bitcoins are currently created. Just understand, gold doesn't have a predictable schedule, or probably yes, because companies come and give their estimates of what they're expecting to do by next quarter. So we can backtrack and say, okay, what's the predictable schedule on gold? Bitcoin, we already know the schedule. And based on that, we find out that by 2140 is when all the Bitcoins will be mined. And acceptability, as long as businesses start to accept, some of the businesses already are accepting it as a currency. But I think more important is most of the financial institutions, they are actually accepting it as a store of value because it is scarce. It's a store of value because you cannot create Bitcoin out of a thin air. Remember, in our federal government has created US dollar out of thin air, almost 6 trillion US dollars. Almost 1/4, 25% of an existing supply has been created in post-COVID. Bitcoin you can't create. It's continued to stay a scarce element. And that is why most of these big money, institutional investors, want to hold this either on their balance sheet or want to hold it as a replacement for a gold. Someone calls it Bitcoin as a digital gold. Okay. Let me look at some of the questions and address that. A question from Manoj. So was a finite number of Bitcoins already created initially and distributed? So the Bitcoins, when the Bitcoins are generated through a process of mining, when it was initially launched, it was very easy to run through that process of mining. It's like 1848 in sunny California, gold rush, you can go and find gold in a stream of, in a water stream, easy to mine. As more and more people started to come in, mining became more and more difficult. Today, we need very sophisticated rigs. I would say a warehouse full of rigs to mine a Bitcoin. So it's out of 21, 18.5 has been mined. I see another question. Why 18.5 mine remaining can only be mined by 2140? It is because one block is created every 10 minutes. Today, when one block is created and added into the blockchain by the miner, they get rewarded 6.25 Bitcoins. So we know that every 10 minutes, 6.25 Bitcoins will be created. In 4 years, that reward will be halved. So the last halving happened in May 2020. Till April 2020, if you add one block to the Bitcoin blockchain, miners were rewarded 12.5 Bitcoins. After May, halving happened. Now the miners receive only 6.25. 4 years, which will be May 2024, halving will happen. Then the miners will receive 3.125 Bitcoins when they mine and add a block. So that's why it's a little predictable. And if you run through the math, 2140 comes out to be the year. What does mining actually mean? I have actually talked about in detail in the previous session. So, okay, I'll take a few minutes to explain it here. Do you think it will be useful for everyone? I just want to make sure because some of you were also in the previous session. So not sure if you want me to go back and repeat everything, or is it okay if I can go through the mining process again? Yes, okay. All right, I see one yes. You can speak up or you can, put your answer. So mining, let me go back and, okay, repetition is good. All right. So let me go back and pick up audit number 1. Just bear with me. Let me where we are on the mining. Okay, so let's get into the detail of how the transaction gets added. So like I was explaining earlier, blockchain is nothing but a chaining together of different blocks or a set of information. So each of the block contain a lot of transactions. So for example, I engage in transaction with you, we keep, and so, multiple other people engage in transactions with each other. After every 10 minutes, all the transactions are picked up and a block is created. Now that block need to be added to the chain through the process called mining. Now, there are thousands of miners working towards it, right? Thousands of computers are running towards to add a block in the blockchain. Now, who should be rewarded? There's a reward for adding the block in the blockchain. Now, how to figure out who should be rewarded for that? For that, each of those miners, they have to run through what's called as a mathematical puzzle. If you want to get into the details of it, ping me, after we are done with our discussion on that separately. Basically, it's based on your SHA-256. You need to keep doing the hashes again and again to find an output of a hash which has got a set number of minimum zeros in the front. So to understand that, you need to understand what a hashing algorithm is. Okay. So, but it's not an easy process. The whole hashing is used even today in almost all the secure systems. Now, to find that particular hash, which has got minimum number of zeros in front of it, you need to run it through the computer once, may not be able to find it. Run it again, run the calculation again by changing some value, may not be able to find it. Run the calculation again by changing some value, may not be able to find it. Today, the difficulty level is, I think, 3 trillion. You have to do this process 3 trillion times. Then there's a possibility that you may be able to find the hash which has got those number of zeros that is required. Now, this requires a lot of work. And this process is called mining. The word mining has come from a traditional, like a gold mining. If I'm a miner of a gold, I have to do the work to mine the gold from the ground. Now, in terms of computers, wherein this Bitcoin, which exists only in internet, this whole work that those computers have to do to find a string, a hash string, which has got a minimum number of zeros in the front, that process is called mining, and it is not easy. The difficulty keeps increasing as more and more computers come into the picture. That is why I said in 2009, it is easy. You can mine it using your laptop. More developers came in. They started to run that mining software. The difficulty increases. The difficulty adjusts itself every 2 weeks based on how much computer power is available on the blockchain of Bitcoin. That is why whenever the Bitcoin becomes more in value, more miners buy more equipment, it becomes more difficult to mine it. That otherwise will create all the Bitcoins quickly. That is why there's a set schedule that if you have put more computing power, the difficulty will change and you will not be able to mine more than, you'll not be able to add more than one block in around 10 minutes. That's the beauty of this whole, how the protocol has been thought through. So instead of doing a physical work, it's the computers who do the work, and that work is called mining. They have to find a hash which has got a set number of zeros. and it is not easy to find. Today, you have to run through trillions of calculations before you could find that number. When I say number, means it's a string, it's not an individual number. I hope I'm able to explain a little bit. If you look at a hash, to give you maybe a little idea about how the hash works. So that will be able to appreciate it. Let me go through the hash generator. And this is one example. I don't know if Bitcoin is using this particular hash or not, but just an example of why it will be could be so difficult. Now, this is, say, one type of hash generator. Now, I got some questions. I'm just going to randomly cut and paste over here. This has created a hash, which is this. I just put some text here. And it created a hash, which is this. Okay. Now, I add some other text here. Random on this. Oops, did I say? Okay. You could see the hash continue to be created. Whatever I can add, the hash is always this string. Now, if I were to make sure that I put in find a value such that the hash becomes with some repeated number of zeros in this string, I don't know when I'll get that. I could actually put a whole document in this, and all I'll get is this hash. Let me try to do that. You know what? Let me add this whole a few page of doc. You can add a Netflix movie in this. You can put a whole Library of Congress, all the book text in this. I've added so much content here, it'll give me hash, but I haven't got any zero. So that is the process of hashing. And in technical terms, it's called a nonce and all other things. I'm just trying to simplify it. That is why it is so difficult. You can't figure out how to get that string, add it, and keep on hashing it so that you can get the number of zeros, minimum number of zeros, which is required in the difficulty. So maybe when it started, you only needed 2 zeros. Or I think the minimum was 8 zeros to begin with. Then slowly it became 9 0, 10 0, 11 0. That's a concept in which the computers run through, keep adding values to find out the hash, which will have those minimum preceding number of zeros. And that is the tough work. And that is why that process is called, that's a process which is called mining. And that is why, it eats up a lot of computing power. As more and more miners are adding computing power, the difficulty keep increasing. It has become more and more difficult. And that is why we could have a predictable schedule. That is why no one can just, tomorrow can create 100 Bitcoins in a minute. No, the process is very difficult and it will adjust if you try to put more power behind it. Okay. So that's the process of mining. Let me see if I hopefully I answered all the questions. Okay, Manasi read all about mining, but never understood it. Hopefully, I think now this is okay. Ramesh says, so this is a rat race? Exactly. So out of those multiple number of miners, whoever has been able to find that nonce, through which they got that hash value, which has got the minimum number of zeros, they transmit to every network saying, I found it. So whoever finds the first is awarded those 6.25 Bitcoins. And then everybody then say, okay, he's got a right to add the block into the blockchain. Everyone now takes that and wait for the next 10 minutes, all the transactions coming in, the process starts again. So it's a race against all the other miners. So is it like an online gaming and you earn rewards? It's not a gaming, it's trying to solve that that's why it is called mathematical puzzle. Difficult to solve, easy to verify. And all the computers are engaged in running through that, trying to solve that puzzle so that they can get the output with those zeros. And whoever does it first gets awarded the Bitcoin. All right, so coming back to today's discussion, we looked at how the Bitcoin is similar to fiat currencies. Now let's look at how is it different. It is decentralized. It is not controlled by any single authority. There are thousands of computers who are running. Each one of them have a record of all the overall blockchain and trying to add our transactions into the next block. So someone wants to shut down, maybe they can shut down a few. There is no single source of failure over here. There's a limited supply. I said, now if you go back, I said, how is it similar to fiat currencies? I had a limited supply and say scarcity, but I had an asterisk here because in 2020, our US Fed has changed my outlook that the fiat currency is in limited supply. I mean, we printed $6 trillion from printing press. So I don't know if fiat currency is really limited supply, but Bitcoin is. So that's why it is different than from fiat currency because it is in limited supply. We already talked about this, and it is immutable. Once a transaction is recorded in a blockchain, Bitcoin blockchain, it cannot be altered. So a hacker or dictator cannot claim something that they didn't own. Today, what's the proof that I own, say, $50,000? It's a Bank of America ledger. Their computer systems shows that I got $50,000. That's the only proof I have. I don't have $50,000 under my mattress. In US, we have a justice system. In many countries, you just don't have that. At any point of a time, dictators can instruct the banks to close their account or maybe just change a ledger entry to claim that now it is dictators. We looked at some example, how some of the dissidents in Russia woke up and found that they actually owe more than $1 million. Russian government instructed banks to change the ledger and to show that now they owe more than $1 million to Russian government. But if it's recorded in a blockchain, you can't just go back and alter it. It is virtually tamper-proof. So that's how it is different. So that's one use case. That's why we saw Bitcoin started as a currency. Now, the limited supply use case, immutability use case has taken over, and no one wants to spend it. They are using it as a store of value. What I see another question. What happens if our transaction go to a node which can't solve the puzzle in time? So transaction is transferred over internet. It's available to all the nodes. All the nodes basically pick it up. So the way it happens is there is, and I'm getting a little more technical than what I would want to. All the transactions get into a pool, which is called mempool. Now, every 10 minutes, all the nodes pick up the transactions. And now some nodes can pick up the transactions based on certain criteria. For example, how much fee are you willing to pay to those nodes? You know, some miners may pick up only the transaction which has got a higher fee. If you are a little lower fee, maybe they'll pick it up a little later. You know, everyone wants to do what's financially best for them. But those transactions are available. Thousands of miners are there. They'll pick it up. If one of the nodes is down, it's okay. The rest of the nodes are still working. So it doesn't go to a specific node. It's available in a separate area, storage area, where all the nodes go and pick up the transactions and then start to record it in a block. Any more question on this one? All right, let's move on. Now, once we had this immutable ledger, wherein if we record something, you can't go back and change it. There were discussions around why not expand the role? Now, even a government cannot go back and change it. Even people in power cannot go back and change it. So now, why not expand the role of this? So now we are expanding the role of this immutable ledger, saying, why limit it to only recording of a transaction? Can we also record a software program in it? Eventually, it's a data. In the computing language, in eyes of a computer, it's bits and bytes, zeros and ones. Eventually, everything is zeros and ones. So whether you're trying to record that I sent 0.0001 Bitcoin to Alec, or I'm writing a program, in the end of the day, for a computer, it's bits and bytes. So there were thoughts around, can we have a programmable money? Means the recording of the transaction could happen based on a condition. And now let's understand the use case, why it is important. In a program that would check certain conditions and then do a recording. Just like a legal contract will check for certain conditions before executing what's in the contract. Now, one use case I see here, and which is, I think, again, benefit a lot of developing countries or underdeveloped countries where there are not so honest officials in the government. One of the use cases is all the charity money or all the aid money that goes to these countries. Haiti had an earthquake. There are a lot of aid money that goes to African nations because the citizens population out there is struggling. But most of the money gets eaten by the officials before it reaches to the end user. Now imagine a scenario wherein we've already established the fact that we can use Bitcoin or any other as a store of value, as a money. Now, what if we have a program which says that if this money is being added into an account which is not in this region, then that money value becomes zero. I mean, it's a software. We could write whatever we want to. So if a corrupt officials try to move the money into its own account, it's gone. So there's the whole concept starting off, can we have a programmable way? And then it eventually expanded to, why leave it only for money? We can write a program which checks for certain conditions. I gave you a very simple example of a condition of, let's say, right now, if you look at US government is giving under the federal assistance program, everyone is receiving a stimulus check. Very well. If there are dishonest officials, they will not give the check to me. They may want to encash with me or pressurize me. Or if somebody has got his check and wants to encash it, today they can, because there's no real logic behind it. But if the same information is available on blockchain, my tax returns are available on blockchain, instead of a check, if it's a Bitcoin or any other crypto asset of a value is being sent on a blockchain with the condition that my 2019 or 2020 taxable income is less than this, then only $1,200 get recorded against my name or my address in this blockchain. It's easy. Anyone else try to steal my money? And if they don't meet this condition, it just won't work. So the idea is, what if we can actually code this program and now no one can alter the program because it's an immutable record? So that's where the whole discussion started. Can we write a contract? Which if once we agree to write a contract, say you and I, we entered into a contract of selling the house. I'll say I'll sell the house and you agreed to pay me the money. We write it as a software contract. And that contract checks the certain conditions that you have indeed paid and my house is transferred under your name only after you have paid. And if that happens, that should become a smart contract. I don't need to have a paper contract. That's where the whole concept of smart contracts start coming in. And why do I need a lawyer? Today, we need a lawyer. We need escrow agents, escrow companies, because what if I don't fulfill the conditions of the contract? You paid me the money, but I don't transfer the deed. Or I transferred the deed and you didn't pay me. But if it is already controlled by software, which I cannot go back and then alter it, it will just run. I cannot stop it, or neither can you. So once we agree, then I don't need that escrow agent. So that started the role of a whole smart contract, wherein now the code itself becomes the law. I don't need lawyers or an escrow agent to enforce the contract on me. And that's when the second use cases start, which is a smart contract. It's a set of promises, but I don't write it on a piece of document. It's a promises which is coded. And those promises will be executed based on whatever has been coded. It includes the conditions which we have agreed. And we both of us, we digitally sign this contract. I sign it with my private key. You sign with your private key. So that's my acceptance that yes, I agree to this contract. So traditional contract is like this. We two enter into a contract, but we need third party to enforce and execute the contract. In a smart contract, I don't need the third party. The code will run. Because I cannot go back and change the code now because it's been coded in a blockchain. And we have seen that it is virtually impossible to tamper the blockchain. So Ethereum came along. Bitcoin was started in 2009. Ethereum came along, I think 2013, somewhere like that. And let's use the concept of a blockchain, but let's add software programs which become immutable. And that became the smart contract projects. Not only Ethereum, we saw many more, EOS, Neo, Solana, Cardano. They've expanded the use of this blockchain technology from just being an accounting ledger to being an entity which can enforce the rules written in a smart contract based on a condition specified in a smart contract and agreed upon by two parties. That's where we see a lot of these new projects, not new, but a lot of these projects now coming up. So I will only talk about Ethereum. I mean, you can go and read about the rest. Just want to make sure you get a little bit concept of how these things work. Ethereum, again, is a decentralized platform. It's a blockchain, runs over thousands of nodes. So that smart contract is now available at over thousands of nodes. You know, you paid me the money and I want to go back and now change the contract. In the real world, I can't change it because there's a escrow company sitting in between. But if there is no intermediary in between, there is always a risk that I can go and now change the contract saying I don't have to give the house, or maybe I have to give a different house, which is not of that value. But I can't because it's already immutable. It's coded, it's in the blockchain. It's over thousands of computers. I don't have that computing power to go and make that change now. Right? So if I can't make that change and my title is available, assuming that title is available online, it will be transferred under your name. I took an example of real estate because it is easy to understand. Today, we don't have our titles available in a digital form. So you can't do it, but it's easy to understand. So it's a decentralized platform that runs the smart contracts. It will run exactly as programmed. You can't bring it down. You can't censor it. I can't, in case of a real transaction, I may go and bribe the intermediary third party, may bribe the escrow agent. But in this case, I can't. I can stop it from running. So normal contract, Harvey wants to sell to Mike. We got our lawyers in between. Harvey wants to sell to Mike. That's where we all these have a decentralized app. There will be soon a decentralized application, which is nothing but a front end created for a smart contract in which we can actually do a mortgage or a house transfer. Today, there are multiple of these decentralized apps exist to do some other stuff. For example, I can loan money. I can loan some Bitcoin to you and you will pay me the interest. And I don't have to know you. I don't have to trust you. Because the smart contract will take care that if you don't pay me in time, whatever collateral was there will be transferred in my name. You can't stop it. Today, I put my money in bank and you take a loan from bank. Because you and I, we don't know each other, we don't trust each other. So we have to depend on bank. In a smart contract, we don't have to. So what Ethereum provides, it's a kind of a world computer. Anyone can go and start creating these applications which run on Ethereum blockchain. And that is why we have seen the explosion of use of Ethereum blockchain, because a lot of these decentralized apps are being created. Decentralized apps in every possible, I would say, area of our transactional life. There are now apps which are being created for that. Okay, again, this is how it works. It works like just a blockchain works. There's an Ethereum blockchain. All the transactions are recorded in a blocks, but instead of putting in a Bitcoin blockchain, now it's being added into Ethereum blockchain. If I'm creating a program, I need Ether. And that is why the ETH, which is Ether, its value went high because a lot of developers, a lot of who are creating these programs, they need to pay the toll in form of Ether. Again, remember, nothing comes free. When you have to run something, you are basically using the computing power of this Ethereum blockchain. The power is supplied by all these nodes. So more complex is your smart contract, you'll have to pay more in Ether. In last 6-7 months, the use cases have exploded. We got NFTs, we got flash loans, we got asset management, we got tons of other stuff. That is why the whole gas in Ethereum continues to go high, because also it is getting congested. So you create a smart contract app, it's on Ethereum blockchain. As a user, I'm using that app. I pay my due through Ether. Miners will verify the transaction. They will add it to the block, similar to mathematical problem. Today, they are all solving the mathematical puzzle. Next session, we'll talk about it. What are the other ways to keep these miners honest and not having to run these calculations. But as of now, even Ethereum, they are running through the same similar calculations what Bitcoin miners are doing. And when they add a new block, they're awarded a miner fee. So now it's an important fact. I know in the media, we've been listening to a lot of stuff saying it's a waste of power. In a way it is, because all you're doing by spending so many cycles of computing power is a Bitcoin is being awarded to miner. Right? But if it is easy to go and add a block, then remember the first thing, a dishonest person won't have to spend too much money now to go and start creating blocks and altering the blocks. So sometimes I feel that the difficulty is actually a feature. It secures the blockchain. So now why it could change the future? These smart contracts, it has a potential to disintermediate third parties. We take an example of mortgage. This whole blockchain started with a single use case. Have a ledger in which you write an entries of who holds an asset. Now we are finding normal uses through smart contracts on Ethereum, on Solana, on Cardano, and many other similar platforms. There are solutions for multiple use cases, decentralized exchanges. Like for stocks, we trade on NASDAQ or NYSE or one of the other 16 exchanges. But now there are decentralized exchanges. No single point of failure. Today, if DTCC, which is Depository Trust and Clearing Corporation, goes bust, they lose their data, I have no recourse to say that I own 50 shares of Apple. DTCC is the record keeper. But in case of decentralized exchanges, we don't have to depend on a single entity. Storage. My data is on Google Drive, Google Storage. Google goes bust, I am done. But there are solutions, Filecoin, Storage, etc., which provide a decentralized storage mechanisms, right? Asset management, insurance, mortgage, etc. Any and every industry that has got intermediaries will be disrupted. I would say it's a matter of time. And why only will be disrupted? We actually have projects which are trying to already disrupt them. So we looked at money use case. There are banking use cases like a compound, etc., which does the same function like banking does. Aave, you can go and take a loans on this. On commercial banking, we can go and take a loans. I can go and take a loan on Aave. I can go and deposit my assets in Aave and earn interest on it. Investment banking. There are protocols available which will do an investment management for you. There are decentralized exchanges already available. There are brokerages. And yesterday, I think it was yesterday, right? When the whole, the crypto world was on fire, Coinbase was down, Kraken was down. But beauty is decentralized exchanges, those were all up. So if I actually wanted to buy, I wanted to buy the dip, I just couldn't even log into my Coinbase account. It kept throwing me the error because I'm stuck with the centralized exchange. Decentralized, again, maybe one of the nodes would have been down, but those are distributed. Those are all running up and fine. So these projects are already happening. It's just a matter of time when they start to move into, our people's lives. So that's it for today. Today, I just wanted to touch base on the use case of an asset of value and a use case of smart contract. So that's it. Let's open it up for Q&A. Let's if you want interested in moving into another room and have some other questions discuss, you can move there. Want to unmute and let's have a normal discussion. Yeah, well, that's what I want to maybe talk about a little bit of a conceptual, because it is important to understand the space. Before you say, I want to buy X coin, Y coin, Z coin. Understand what is it trying to do. Understand the economy. Otherwise, we'll never have that conviction. And if you're just getting into this because your friend told you made money, because he bought some coin and then sold off, and that's the only reason you're getting in the next downturn, you'll be cursing yourself and trying to, just get out of it and say, okay, I'm done with it. This just doesn't work. So my idea is to maybe share a little bit around the basics, how these things work, so we understand this ecosystem. I will look into some of the questions.